All right. It's 5 p.m. in the East, which means it's time for another all-new edition of What Are Your Thoughts? My name is Downtown Josh Brown, for those tuning in for the first time. My lovely and adorable co-host wearing a collared shirt today, Mr. Michael Batnick. Michael, say hello to the folks.
Hello.
Sorry we were 1 minute late. We are running Crowdstruck in conjunction with Microsoft Windows. Hey, guys, it's so exciting to be here. I want to say hello to some of the faithful. You guys join us for the live all the time, and we love you so much for it. Jeff Asola, John Carlo, Drew is here. I see Magnus in the chat, Georgie D. Who else is up in here? Roger is here. Nicole's in the chat, guys. Say hello to Nicole. Who else? Listen, everyone's here. Zoe is here. Hello from Greece. Hi, Zoe. I wish I knew how to say hello in Greece, but I am just not that cultured. All right, guys, we have a big show tonight. Lots of stuff to get to. I want to make sure we give a big shout out to our sponsor, Rocket Money. What's the story with Rocket Money? What are we saying tonight?
Let me say it, and I'll say it. My favorite personal finance app, and not just me. There's over 5 million users, and they help you save money on unwanted subscriptions. You can cancel them right inside the app. They track your spending. They categorize it when you get a refund. They send you refund detected. You spend money here, there. I love it.
It's almost like your own personal online superhero, like defending you from people that are just pulling money out of your account. Rocket Money will even try to negotiate to lower your bills for you by up to 20%. All you have to do is submit a picture of your bill, and then Rocket Money just goes to town. They go right to customer service for you. Over 5 million users have saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when they use all the app's features. Stop wasting money on things you don't use. Cancel your unwanted subscriptions by going to rocketmoney.com/compound. All right. We have to talk about CrowdStrike first. As many of you are aware, I am personally a shareholder in CrowdStrike. I have been for almost 5 years.
And a technical advisor.
Listen, we've had George Kurtz, the co-founder and CEO on the show, and I think he's incredible, and what he's built is amazing. So it really sucked watching what unfolded on Friday. And of course, my first thought is to anyone affected. I actually knew some people who were dealing with canceled flights and delayed flights, and there's nothing good you could say about it. But effectively, CrowdStrike pushed through a software update to Windows users. This affected 8.5 million computers. They did that overnight, and then on Friday, employees at companies and government and airlines and banks went to work, turned on their machine, and they got the blue screen of death because of a glitch that was part of the software update, something that they do routinely all the time. So George Kurtz did television the entire day. I saw him on the Today Show, saw him on CNBC. I think, he stood and he took it. And, he's apologetic and he's professional and he's transparent, but the error is the error. And nothing can really change that other than how they react to it. What were your thoughts when you saw that, Michael?
I'll throw it back to you. Were you surprised that the stock was only down 10% or 12% at the open?
Well, it fell 15%, and then the next day it fell another 15%, and today was the quote-unquote bounce, and it barely went up. And I think that's reflective of reality. There are going to be lawsuits. There are going to be probably refunds. I wouldn't be shocked if Congress calls him to testify, because this affected a lot of shit, like, all over the world.
We couldn't trade?
Yeah. So we're Schwab users, and we had connection issues that morning. Fortunately, rectified very quickly. Shout to Schwab. But there's nobody that wasn't affected. It seems like, among corporations, they did say that this didn't affect every Windows machine, and it did not affect anyone running Apple or other services. One of the interesting things is that because of European Union rules, there's something called the main kernel, where your software update is so highly privileged that it literally could alter like the main kernel of a computing system. Apple doesn't allow that. Microsoft does, in part because Microsoft was forced to open up in some way because of, I think, antitrust reasons. But that's kind of like a side plot. That's not really the main thing. The main thing is they have to earn back 10, 12 years worth of trust that was lost in an instant. And fortunately, it wasn't a hack. Fortunately, it wasn't something where, oh, this cybersecurity system doesn't work. It was just company error. And look, I'm sure they're all sick to their stomach about it, and it's going to take time. And I
don't know.
Let me ask
you this: in the times that we live in, where it's nothing but headlines and on to the next thing, how quickly does this blow over, or maybe not?
Somebody I know said, "Hey, on the bright side," I don't agree with this, by the way. On the bright side, every person on Earth now is aware of CrowdStrike as a cybersecurity
All press
provider.
is not good press. All press is not good press.
I don't. I want to read some comments from Wall Street. So, Joseph Gallo of Jefferies described this as, quote, the most important and will likely significantly constrain potential upside in fiscal second quarter as new customers await assurances that the situation has been handled. Itai Kidron of Oppenheimer agreed this is a major blow to CrowdStrike's reputation and would most likely weigh not only on investor sentiment, but on business activity for several quarters ahead. So this happened right at a period of time where, they're trying to close business, and maybe business doesn't close, and maybe that has an effect on the next quarter they report, like customers holding off. So the sentiment hit has already been taken. We haven't seen the financial fallout yet.
So if a company is deciding to use them, they're in negotiations, and they say, time out, no, we can't trust you. Who do they go to? Who's number 2 or 3?
Well, so you saw rallies in shares of SentinelOne, which is a recently public. They have the ticker S. They took it from Sears after Sears went bankrupt.
I thought it was Sprint. Sears. Okay.
Maybe it was Sprint. I think you might be right. Actually, Sears was SHLD.
Sears. That's
after
right.
Right. All right. So SentinelOne rallied. Palo Alto caught a little bit of a bid late in the day too. So these are companies that will use this to sell against CrowdStrike, and they'll say, "Well, we didn't do that. How can you trust? How can you trust them?" So I don't know if that's a 1 quarter story or a 1 year story.
I'll take the end on that. You know what else I know, Josh? I know that gaps get filled, and
it's a pretty monster gap, dude.
Okay, 305. It will get filled. I don't know when, but it will get filled.
Here's a couple more analyst comments. Guggenheim downgraded. Well, great, thanks. John DiFucci said the stock was still trading at the highest multiple of recurring revenue across our entire software coverage. We still have the utmost respect for the leadership team at CrowdStrike. Believe the company will eventually become even stronger, which I agree with. If investors have a multi-year horizon, they can ride it out. However, we find it difficult to tell investors they need to buy it now. Goldman Sachs maintained their buy. They put out a note on Monday morning. Analysts said they expect CrowdStrike's deals to take longer to close. Duh. Our recent conversations reaffirm our view that there will likely be minimal share shifts in Endpoint post this event, although we recognize additional details in the postmortem will further inform this view. So all the shoes haven't dropped yet. I thought this one was funny. Let's put this up. This is Deutsche Bank, and someone sent this to me. I don't know who did the highlighting, but basically there is a company, likely $1 billion lesson, thoughts on outage. But then they said, our initial reaction on Friday was seeing a 10% pullback in a high-quality stock as a buying opportunity. However, we were ironically unable to publish our original research note due to the outage itself. So that's the definition of irony.
Yes.
What is this chart here?
It's their revenue, and I just wonder. Like, obviously, we don't know what this is going to do to fundamentals, and to your point, like the bigger known is valuation, is sentiment. How quickly does the negativity wane and get over it? And I don't know. We'll find out.
I think revenue actually will be the least affected part because they sign multi-year deals and they have big enterprise business. And I don't think they get dropped necessarily by a lot. I think what will really be affected is revenue growth.
New customers, because
Yeah.
the switching here is massive. You're not going to do that.
Right. And also, there's going to be an earnings hit because money is going to have to change hands here. You had 1,000 something flights canceled, another 3,000 flights delayed. Like, money will be changing hands here. And they're also going to have to look at how they're doing these updates and probably make some big investments to make sure that this never happens again. That's the promise that they're out there making. One thing that I was on TV today and not like defending the company, but just talking about why I didn't sell it. And again, I've ridden this thing down already. I've seen it get cut in half in 2022. And I'm not a trader in the stock. If I were, I probably would have sold it. So one thing is instructive is Chipotle. I think it's a similar situation, but Chipotle might have been worse. So in 2015, the first reports of a norovirus outbreak came as a result of one of the Chipotle stores having inconsistent health oversight. And then all of a sudden, these outbreaks started happening all over the country. Chipotle was in its highest growth phase in the mid-20 teens. And they're trying to do something that no other quick service restaurant is doing. Everywhere else is serving frozen food. Chipotle is handling raw steak and fresh produce. And they're growing so fast that they're just not managing the growth and managing the employees. And so they have these outbreaks of norovirus all over the country. And of course, there's probably some things being reported that weren't even real just because it became like an epidemic. So that's 2015. The last reported case was 2018. They paid a $25 million fine in 2021 to put it to bed. But there were criminal charges being considered at one point against Chipotle, believe it or not. Had you sold the stock in 2018, you missed a 10-bagger. It went from a split-adjusted price of $6 back up to $60-something earlier this year. So from 2018 through 2024, over the next 6 years after they got their shit together, the stock 10x'd. And I'm not saying that's going to happen here, but I think people should understand that with really high-quality companies, what doesn't kill you makes you stronger. Put this drawdown chart up. So you could see, like, this was not a fun experience to be down 70% in Chipotle into 2018. But, if you made it through as a shareholder, you survived. And I hope, for the sake of George and the whole team at Crowdstruck, that they can get past this and they can rebuild some of that trust that's been lost. It's not going to be easy.
All right. Anything else to say?
No. Look, I don't know that I have any real answers about like what happened technically. So I think like my perspective is from a shareholder perspective. I know there were cybersecurity experts out there who are like doing what's it called, threads and all that. That's fine. I don't know about that shit. I just know that this is a really high quality company that made a huge mistake. And in my experience, if they really are a high quality company, it'll at some point fade away. So
Agreed.
I don't know when that is. And by the way, I didn't buy any more. My average cost is in the low 100s, but I do have some buy stop limits, good till canceled, and maybe I'll get hit on one or two of them. We'll see.
Okay. Let's talk earnings. We're going to do some Google, some Spotify, some Tesla. Let's start with Spotify. So the story with Spotify is that it's been a great product for forever. It's been a great product. It keeps getting better. The problem is the business part of it wasn't following through. The podcasting, it just wasn't a great business, and you had to be patient as a shareholder. But it looks like they're on the other side of it now.
They made a big bet. They made a big bet that people that like to listen to music on the app will also like to listen to shows, and that was true. The problem was they wanted to build it themselves, and they wanted to own the content. So they made deals with the Prince and Princess of England and Michelle Obama, and they bought Bill Simmons for a ton of money, and they bought Joe Rogan, and they kind of were trying to build like the HBO of podcasts.
Yeah.
But as you and I know, podcasting is not a huge business.
So that part of it didn't work, but they were able to pass along several price increases, and the customer didn't blink. So let's get into it. On that conference call today, Daniel Ek said, as you will recall, a few quarters ago, I said that while many believe that Spotify is a great product, we needed to prove that we could also be a great business. I think we're really starting to show this now. He said, we also implemented a price increase in several key markets, including the U.S., which we're rolling out now with great success. In fact, we're seeing less churn in this round of increases than we did in our prior one. Let's go through some charts, please.
Wait, are you surprised by that?
No, because who's the number 2 player here? Honestly, if you're a Spotify user,
Apple.
yeah, but how far behind is Apple?
I use both, but I love Spotify. I'm a little bit surprised that they saw less churn this round, because one of the themes that we're hearing from companies everywhere is that the consumer has reached the point where they're like, no more price increases.
They're making choices. The consumer's making choices. I feel like with Spotify, there's no other choice. I know there is, but you know what I mean. Like if you're a fan of music and stuff, it's by far the best.
I can't live without it, so I agree with that.
Okay, chart on, please. All right, total monthly active users, 626 million, up 14% year over year. Premium subscribers, which is where most of their money is made, is up 12%. The ad-supported tier is up 15%. Financials look good. Margins look great. Look at the gross margins from 24% in the second quarter of last year up to 27%, up to 29%. We're going to get into where those are coming from. Next chart, please. Monthly active users on the left, pretty incredible growth. The next chart is ad-supported users, which is the majority of it. Majority of people are using like the freemium version. But the premium users are where their bread is buttered. You can see that on the next chart, like in terms of the dollars. That's the blue bars. It's all premium. Next chart. Gross margins, pretty damn incredible, right?
Yeah. Can I say something crazy?
Hold on, last one, and then you could jump in. Next chart, please. So one of the reasons why they've been able to increase their margins is they're getting their expenses under control big time. So their total operating expenses are down 16% year over year. It peaked, 7 quarters ago. So huge credit to the management team there. Go ahead, Josh.
All right, put that last slide up. Nope, the last one. Yeah. So what this is they stopped doing stupid deals.
Yep.
I mean, it's really that simple. I think they've recognized, yes, it's nice to own Joe Rogan and to sell those ads internally rather than split it, and that's fine. But there are not like 20 Joe Rogans. Like they're just at a certain point, there aren't enough high quality, big audience shows to buy, and this idea that they're going to develop them themselves, we're going to get Meghan Markle and she's going to be a podcast sensation. Like I think that part they figured out is not really going to happen. I guess I don't blame them for trying, but that's not going to be a thing. Bill Simmons actually pointed out. First of all, he called them grifters, the Royals, when they signed that deal. But Bill Simmons said the problem with having celebrities and giving them a podcast and writing them $50 million check or whatever is it's like the 9th or 10th thing these people are doing. Like even the Kardashians I think they had a Spotify deal to do a podcast that fizzled, because if you're not doing it full time, if it's not the main thing that you're doing, the odds of you building an amazing show that people keep coming back to week after week are zero. It doesn't matter how famous you are. This is not a thing where it's like, oh, let's get David Beckham and everyone loves him, he'll do a show. Like it doesn't work that way. It's an art and it's a skill, and celebrities don't automatically possess that skill. Any famous person can get somebody to listen to a podcast once. Can you get them to listen 7 months later, 8 months later, just because you're famous? Not if you're not doing a good show. So that's that expense reduction. Here's a crazy thing I wanted to say. Is it nuts to call this thing Netflix?
No, not at all.
Audio Netflix?
Not at all. I'm pissed. I bought this stock and I sold it like a year ago. Shame on me. No, it's not. It's not. They Spotify won. Spotify won
like
the
they
audio.
were their own right.
They won audio streaming, for sure.
So here's another thing, similar to Netflix. There's not going to be any new ones. So like 5 years ago, everyone was launching a streaming. So nobody's launching a streaming service, maybe ever again.
Certainly not audio.
No way, dude. What venture capital firm is signing up to start writing checks to someone that's going to compete with Apple and Spotify and audio? They won. It's over.
It's over.
It's over. But I love owning a business. Like I did this with Uber, right at the moment where it's like, oh, no one's ever going to try this again. It's too late. Yeah. That's where they are.
Yeah. So, and similar to Netflix, they went through it. Like the stock got fucking murdered. It went. I think it was down 70%. Let's go to two last charts. So all of this good stuff results in explosive free cash flow generation, by far the highest in the company's history. And last chart just shows they're close to an all-time high after really, really, really going through it over the last couple of years. So credit to the management team, to shareholders that stuck it out. You've been rewarded for the pain, so credit to all involved. All right, let's do.
Can I tell you an embarrassing story? You know my friend Brooke? Mm-hmm. So she talks to Daniel Ek. So I'm like, oh, connect me with Daniel Ek, because I love. I'm not an investor in, but I just love I wish I were an investor. I just love it. So I'm like, oh, connect me with Daniel Ek. She's like, yeah, no problem. Josh, meet Daniel on email. I'm like, hey man, we're huge like users of Spotify to upload our shows and our podcast. He writes back, he's like, congratulations on having a podcast.
Ooh.
Like not in a dickish way, because he's like Swedish. I don't even think they're capable of that. But I was like, why did I send that email? I don't remember why I did that. Anyway, go on. What do you got?
Okay, Google. How's Google doing in the after hours? Numbers look good. Google stock. I forgot that they instituted a dividend last quarter.
That's right.
Remember that? The stock is down 2%. I think the knee-jerk reaction was higher, but it's now down 2%. Okay. All right, let's go through some shit. This is from App Economy Insights. This shows their income statement. Of course, up top, the main driver of their business is the search advertising, which grew revenue 14% year over year. YouTube is still chugging along, up 13% year over year. Google Ad Mob, Google Ad Manager and AdSense, okay, that's up 5% year over year. Google Play, Fitbit, Google Nest, YouTube is up 14% year over year, and the cloud still exploding, up 30% year over year. Not bad.
Ad sales up 11%. Last quarter, it was up 13%. It's still double digits. This is still one of the largest companies in the world finding a way to grow double digits year over year in its core business, which I think is pretty impressive. I think the cybersecurity startup they wanted to buy, Wiz, we're going to talk about this later, actually. I don't think that's impacting the stock, really. I don't even know what the reaction would be if they would have been able to buy it. $23 billion would have been Alphabet's largest acquisition of all time. So I don't even know if that would have been met favorably. Did you see anything about YouTube in here?
Yeah. And not only did I see it, we just said it. It was up 13% year over year. 13% year over year.
13. Okay.
John, let's throw up the Consensus Gurus earning recap. So this company, Consensus Gurus, does great work on all this sort of shit. Look at all these numbers. Year over year revenue, as we just mentioned. Like these are, at this number, there's no slowdown. It's wild.
It's wild. I mean, it helps that they're number 3. So Microsoft
what, in cloud?
In cloud, Microsoft. That's all the growth is going to be cloud. Yeah. Microsoft Azure is neck and neck with Amazon Web Services, and then Google is a distant 3. I think Oracle is a distant 4. This to me is similar to the conversation we were just having. There's not going to be an 8th largest cloud provider, that anyone cares about. Like at a certain point, this is just what the business is. And that's
so next
why
chart, I want to
find growth.
I want to ask you about this. So Alex Morris shows YouTube trailing 12-month ad revenues have doubled over the past 4 years. Bananas. It's at a $35 billion run rate, give or take. Chart off. So Josh, I was listening to Bellany and Lucas Shaw talk about YouTube versus Netflix because they won, right? It's them two and everybody else is in the distant rear view. And
I think a lot of these other streamers are going to end up as channels. that you access through YouTube and Amazon Prime.
Yeah.
And there'll be a revenue sharing agreement. And then, the question is, can YouTube become the central television interface for Gen Y and Gen Z? Like, can YouTube become synonymous with TV, where you turn on your TV and you access everything via YouTube, whether it's regular television channels or movies or whatever? And Amazon and Netflix to a lesser extent, Amazon Prime has that same ambition. And I don't know that one has to win, but what the losers are the cable companies, who will be reduced to basically providing broadband at some point.
I think Prime Video is actually a pretty good service, but the question that Lucas was asking is Netflix more likely to maybe not catch up, but to really compete on the ad side with YouTube? Or is YouTube more likely to compete with Netflix on programming? And that's the big question. We'll see.
I would say that Netflix is further along to being able to do the first thing than YouTube is to being able to do the second thing. YouTube, effectively, YouTube incubates talent, and then Amazon comes along and writes Mr. Beast, $1 billion check or whatever. The idea of YouTube going from user-generated to a Netflix-esque studio.
It's a hole in the ball of wax.
Purposely, that is expensive and probably dumb. Netflix is immediately in the game for programmatic advertising. They built the engine a year and a half ago. It's working. It's actually their most profitable segment. They're actually cutting out a middle segment. They're raising the lowest tier of the ad-supported service to a higher price. I think it's $11 or something, or $11.99 or whatever. So I think there's a better chance that Netflix brings the fight to YouTube than YouTube brings the fight to Netflix.
But interestingly, they say that YouTube, the estimates are if YouTube was a standalone company, it would have a market cap of $450 billion, give or take.
I would not be surprised by that at all. If you value it the way that these other platforms are being valued, it's bigger than all of them. So
Netflix's market cap is only $275 billion.
One of the things here that's so hard for older people, even on Wall Street, to wrap their heads around is how little the younger generations distinguish between content that... All right, so Apple made the show called Masters of the Air. They spent $300 million on it. At gunpoint, you couldn't get a 16-year-old to watch more than 5 minutes. At gunpoint, they would tap out. Younger people will endlessly watch things that cost $0, and the algorithm will surface up the best of that stuff and make it even bigger. But the kids don't really distinguish between, Martin Scorsese directed this 4-hour monstrosity.
Josh, people are spending more time on Netflix per day than they spend on Apple for the entire month.
Yeah, so Netflix spends on content too. They have gotten religion on that. They're doing less episodes of their series. They're doing them cheaper. They're doing less prestige stuff. I'm sure Apple has learned their lesson also. But YouTube, it's free content. That's really the conversation is dude, this is free content that other people are creating in the hopes of getting famous or sharing an ad revenue. And YouTube does not have to do what HBO has to do, what Paramount has to do, they don't have to do any of that stuff. And they make even more money. It's incredible.
Let's do Tesla real quick. Tesla's down in the after hours. Let's throw some charts on, please. Down 4% in the after hours. All right, so they did well on the top line, beat in terms of revenue for all their segments, but
what
the margins and the cash
here?
flow.
It's deliveries and margins, right?
And guidance.
Those are the two things?
And guidance, and none of it is looking particularly good. Let's run through some charts. So the market share, in the U.S., look, it plateaued. It's not, they invented the category more or less, but it's just not growing very much. In Europe, it's rolling over. In China, it looks like it's peaked. And if you look at the key metrics on a quarterly basis, vehicle deliveries peaked a couple of quarters ago. Operating cash flow, free cash flow, it's probably not terrific.
I think the right way to say this is Tesla is still the dominant EV player, but we're in a time where that might not be such a great thing. There's a political backlash against EVs that I think Elon cozying up to Trump and the right is probably designed to circumvent or turn around. There's just less, and it's not even just political. There's just, we already saw most of the people who were dying to get an electric vehicle, and the next class of buyers is not materializing at the same rate. So that's one major issue. The second issue you mentioned, competition. So far, there aren't really a lot of hit EVs coming from anyone else.
Mercedes has a lot of cool ones coming on.
Yeah, the EQS. I was going to test drive that, but then I didn't feel like going to the dealership. My friend has the electric Porsche, which is pretty cool. But it's just, you're not going to outsell Tesla in EVs. I don't think anytime soon. But the question is, having the dominant share in a market that's not growing as fast as everyone once hoped it would is
not
difficult.
great. Not great.
It's not great.
All right, let's move on.
All right. Where are we going next?
Charge-offs?
So something to keep an eye on, I think. Basically, my read of this situation is that affluent consumers continue to spend like there's no tomorrow, no let up in sight. You're hearing that from pretty much everyone. Mm-hmm. But the lower income and middle income consumers are showing signs of buckling. And part of this is under the weight of the higher prices. And part of this is because they're not getting raises or upgrading their jobs at the rate that they were. Part of this is some of the pandemic era stimulus has run its course. Part of this is fatigue. The job market is weakening. And in the financial company earnings that we got last week, we started to see the first signs of charge-offs noticeably ticking up. And just kind of feel like we should be aware of this. So let me run you through a couple of these numbers. Citigroup said its net credit losses, this means debts that they don't expect to collect, hit $2.28 billion in the second quarter. That is a $780 million increase from what it was in the same quarter in 2023. Okay, not catastrophic, but materially higher. Bank of America says net charge-offs hit $1.5 billion in Q2. That's a 66% rise. It was $900 million in Q2 23. They also said provision for credit losses jumped by $400 million to $1.1 billion. To $1.5 billion. Goldman Sachs said net charge-offs hit $359 million last quarter. Where are their charge-offs coming from? The credit card business? Is that Marcus stuff?
Honestly, not
I
sure.
thought they were getting out of the. All right, whatever. J.P. Morgan said they lost $2.2 billion last quarter due to uncollected debts. Wells Fargo recorded $1.3 billion in net charge-offs. This is just for Q2, guys. So to me, that's what's notable. In May, the Federal Reserve raised the alarm on rising levels of overall debt. They said U.S. household debt reached $17.69 trillion in the first quarter, which was a $640 billion year-over-year surge. So, of course, the thing with looking at household debt is you also have to say the economy is larger, too. But I'm just saying, this is really the first time that we've had some meatiness to these numbers, right?
No. We had them.
Okay, say more.
We had it last quarter, and I would say, listen, I'm not hand-waving this away because we're going to get into some quotes from these banks. The stock prices all look good. But the stock prices can look good while the lower consumer is perhaps not as good as it was. Both those things can be true. So here's Mark Mason. He's the CFO at Citi. Across our card portfolios, approximately 86% of our card loans are to consumers with FICO scores of 660 or higher.
Right.
And while we continue to see an overall resilient U.S. consumer, we also continue to see a divergence in performance and behavior across FICO and income band. When we look at across our consumer clients, only the highest income quartile has more savings than they did at the beginning of 2019.
Yeah.
Lower FICO band customers are seeing sharper drops in payments and borrowing more as they are more acutely impacted by high inflation and interest rates. That said, we're seeing signs of stabilization and delinquency performance across our card portfolios. John, throw this chart on. I'm just going to flex a little bit for quarter. So the highlight. So this is the transcript section of the quarter wrap.
So good.
Brian Moynihan from Bank of America said, in previous calls, many of you have asked questions or commented upon the question about consumer net charge-offs and when they would stabilize. In the second half of 2024, and that expectation remains unchanged. This quarter net charge-offs were 59 basis points. And for context, this is a stabilization of the rate. I would just remind you to that prior quarter, I have to go all the way back to 2014 to see a charge-off rate that high, and that's near when we were still emerging from the financial crisis. Let's run through some charts. I think this helps paint the story. Credit card update, 30 days past due and 90 days past due. They're down from where they were a quarter ago.
How are they down? What am I not reading?
The top two. So 2.3%. They are down. The gray line.
The gray line is last quarter and the blue line is now?
The gray line is delinquency rate. What is the blue line? No, the gray line is the blue line is the dollar amount, and the gray line is a percent change.
Ah, okay. And that's versus 19 though. That's not versus last quarter.
No. Last quarter. So keep going.
Okay.
This is not the exact same number, but it's seeing like a plateauing. So in Q1, the net charge-offs was 58 basis points, and it's 59 basis points in the second quarter. So
Okay.
not, stabilizing, like you said.
Okay. I think if you were to tease this out amongst various groupings of income, you would see that it's only stabilizing at the 740 FICO score households. And it is definitely not stabilizing at the low end. And then I want to just say something.
Well, hold on, not definitely. He said that it's good. He does think it's going to be stabilizing in the second half.
Stabilizing for the lower income, lower credit score people?
Yes, he did say that.
Okay.
And one last chart. So looking at what I highlighted here is consumers that are 90 days performance past due. In the first quarter, it was 1.531 billion. And this quarter, it was down to 1.474 billion. So again, not hand-waving it or saying that it's like not something to pay attention to, only that it seems to be potentially stabilizing.
If the numbers go up next quarter, they'll stop saying stabilizing.
Correct.
I'm not saying they will. I'm not saying that will happen, but I'm saying if it does happen, you're not going to hear that word anymore. Nobody wants that word to be like transitory inflation. You know what I mean? One thing I want to say, and I know you know this, so I'm saying this for the audience. My spending is your income, and your spending is my income. And yes, we could have bifurcation, and yes, we can have periods of time where the wealthy run away with the ball and leave everyone else standing around. But in the end, everybody has to spend for this thing to work, and it breaks when you've got millions and millions of households that just drop out and they're no longer consuming at the rate that they were a year ago. The comps get worse for everyone. And there's no such thing as a standalone luxury goods market or a standalone high-end travel. It just does not exist because the wealthy people are wealthy because they own shares in companies that sell things to the not-so-wealthy. And when those not-so-wealthy people stop buying those things, their stock prices fall and their paper wealth subsides, and then they themselves start spending less. And we just know it's not a sustainable situation if we think these charge-offs are going to continue to rise and the high-end consumer is going to act like it's not happening. I just don't think it's possible, quite frankly. So
I agree.
A lot of stuff is being held up right now by the wealthy consumer and the wealth effect and record high prices for stocks and bonds that are spitting out tons of cash. It's great. I'm not anti. I love it. But it's not sustainable if these delinquencies start to rise materially.
I agree. Agree wholeheartedly. I just want to make sure that we're not painting a picture like the lower income consumers are completely screwed, because it's just we're not seeing that data just yet. But I agree with your point.
You're right. But you can't say the same thing about the lower end consumer that you could say a year ago.
True. Also
which is
true.
that everyone's humming, everyone's going 100 miles an hour. That is just not what's happening today.
Correct.
So.
Last chart that I want to focus on, I think it's from Bank of America. They had $950 billion of average deposits in the second quarter, paying 60 basis points. Come on, people. What are you doing? Get out of there. Get out of there. Okay. Let's move on. Urian Timmer tweeted,
Love him.
put this in the quote, I thought I'd seen everything department. The 13-week correlation between the S&P 500 cap-weighted index and the equal-weighted index is now 36%. That's between two indices that have exactly the same constituents. It's normally 99%, as one would expect. This is some hell of a chart.
So this is just the extent to which the largest stocks have pulled away from every other stock. And yeah, look at it. Look at this yawning gap between the two. That truly is historic.
Shit, I forgot to put a chart in here. All right, next chart. The chart that I'm missing is the percentage of stocks outperforming the index. It had quite a snapback, sort of similar to this. So what we're looking at here is the rolling 8-day difference between the equal-weighted version of the S&P and the cap-weighted version. And what you're seeing, where I want you to focus your eyes, the red line and is drawn to the gray bars, which are showing those like massive thrusts where the equal weight destroys the cap weight. And interestingly, that used to happen at or around market bottoms, and that's not happening this time.
Yeah, we talked about this with Todd. It's a breadth thrust, but it's legit, but it's coming at a really strange time. But not such a strange time if you just follow the market via equal weight or via Russell 3000. It's only strange if you follow the S&P 500 in isolation.
Right.
Like, why is there all of a sudden a breadth thrust after what the S&P just did? Usually this happens at bottoms, not at all-time record highs. So it's a really weird phenomenon. And for me, the takeaway is unprecedented things happen every day. And this is just like yet one more example for our, that we could remember and point out. So I think that's good. The largest IPO of the year this week. What do you think about that? Do you know what it is?
I don't know this company. I'm not familiar with them.
All right,
not
me
familiar
either.
with their game.
Me either. I learned about it hours ago. Lineage, ticker LINE. This is a temperature-controlled warehouse REIT. So it's a real estate investment trust that owns these refrigerated facilities, mostly for the distribution of groceries and medicines. And this thing is, to date, going to be the largest IPO of the year. They're going to raise $3.85 billion, led by Morgan Stanley. There are 28 other investment banks in the syndicate. They're going to be valued at $19.2 billion if they get their pricing. I thought that was really interesting because one of my big themes for the second half of the year is the return of capital markets. And this is a great confirmation bias for me. Companies based in Michigan. It'll be the second biggest deal of the year will now become Viking Holdings, which already happened. They raised $1.5 billion. That's the cruise ships. And a $20 billion IPO is no big deal. It's a big deal, right? Congratulations to NASDAQ. They're listing on NASDAQ. The fact that there are 28 underwriters is interesting. That's the capital markets theme. Everybody back in the pool. They all wanted a piece of this. And more interesting, the founders were investment bankers working at Morgan Stanley. And in 2008, they looked at this industry. There's one other public company, Cold, C-O-L-D is the ticker. That's Americold. It's tiny compared to this. But these Morgan Stanley bankers looked at the industry in 2008 and said, this is a fragmented business, and we could actually make it really efficient, and we could build something, and they did. And I guess they'll be billionaires now. I don't know how much stock they still own. One other thing about this IPO theme, Wiz, which is a $23 billion, was about to be valued at $23 billion by Alphabet, said, no thanks, we're going to go public instead. I don't know that they would have said that last year.
No chance.
No chance. Definitely not the year before. So all of this is kind of confirming what I think we're about to witness in the second half. And I don't know if Wiz is going to go public this year, but just the idea that a company that was raising money at a $12 billion valuation can now say fuck you to $23 billion, to me is notable. And this is one of the reasons why I think my position in NASDAQ, NDAQ, is going to work.
I want to
because
join you.
NASDAQ,
It looks like it's about to
NASDAQ
break
looks
out.
sick right now, right?
Yeah, it looks really good.
like a breakout, and they're going to get a ton of these listings.
Yeah.
And they're in other businesses, but that's a big driver. You have this Renaissance IPO ETF here?
Yeah,
Let's
look, it's
cue that
behaving
up.
a lot better.
Pull this up.
I mean, obviously, the thing was at the epicenter of the storm in terms of destruction of shareholder value, but it's been acting much better.
Okay, this is now at a 2-year high, above a 2-year high. It is below its 200-day. I don't know if this is a week, 200
No,
week
it's not.
moving
No,
average.
it's not. No, it's not.
What am I looking at?
That's the 200-day moving average. The orange.
It's above. It says above it.
Yeah, you said
Yeah.
below.
I didn't mean to. What's in this thing is recently public companies. And I don't know how long the ETF holds a stock after it goes public. Is it 1 year?
I thought it was a year.
Okay. So, yeah, signs of life. And I
Love to see it.
do believe the capital markets theme is going to work out. Okay, you're up.
All right, I want to talk about Vanguard's future. So there was a profile of them in the Wall Street Journal a couple of weeks ago, and they found a person, as they always do, to give a quote, and this time it was Theodore Wagoner, a 75-year-old retired college professor who has been with Vanguard forever. He said the final straw came after he was locked out of his account for days. It was difficult for me to leave them. My heart is with Vanguard and their mission, who has been a customer for 40 years, but it just continually got worse. The service is abysmal. Vanguard is ranked last out of 8 major brokerages for customer satisfaction. So obviously Vanguard made its bones with index funds and just grew from there, and they serve millions of customers around the globe. But they have a new CEO, the first time that they've brought in an outsider to right the ship, and the ship that needs righting is the technology stinks, and the customer service is strained.
Can I talk to you about my triangle? Do you know about my triangle? That's enough. Your
triangle
eyebrows
of-
are raised above your forehead, so that's
The
enough.
triangle of sadness? What triangle?
Yes, the Josh Brown triangle of sadness. Picture, if you will, a triangle, 3 sides. I didn't invent this. I'm like half paraphrasing and half stealing it. But you have 3 points. One of those points is cheap. One of those points is fast. One of those points is high quality. So, as a business, I say to you, my customer, Michael, you can have it fast, or you could have it cheap, or you could have it high quality. Pick any 2.
Wasn't this the crypto trilemma that you're describing?
I don't know. Is it?
I think it is. Go ahead.
I didn't invent this, but this is a truism that
Yes.
I have come to accept. Nobody can do all 3.
Correct.
Or you could do all 3 for a little while, but you'll run out of money, or you'll burn your workforce out. You could be the fastest version of something. Here, I'll give this to you tomorrow. That's H&M. That's Zara, right? Fast fashion. Like, this trend is taking off on TikTok on Monday. On Tuesday, we have the closing stores. Okay. You could be the cheapest. That's Vanguard. Literally, the lowest cost way to invest. Fantastic. People love it. Unbelievable. You could be the highest quality. You could say, hey, we make the best version of this. Nobody can do all 3 in any industry. Just it cannot be done profitably. So in Vanguard's case, they're giving you the lowest cost. I would argue they're giving you the highest quality. They can't give it to you the fastest, meaning good customer service. Like, they can't respond to you instantly also, because to do that, you got to pay people. And if you have to pay people, then you can't be the cheapest. So that's the dilemma. Now, could they make improvements? Of course they can. And I'm sure they will. But if there's another company charging a little bit more, they could use that excess income to spend more money on customer service than Vanguard
I think
can.
some of the frustration from investors is the index funds obviously run just fine and they're dirt cheap, as you mentioned. But what's so funny? Let's hear it.
These motherfuckers are laughing at my triangle. It's true, though. It's just
No,
dispute
it's an isosceles. I dig it.
I believe it's an ISA.
But when you are trying to not just be in the index fund business, but the advice business, and you're doing that with human beings and you're charging nothing, yeah, it's hard to do that profitably and well.
you want to know that Vanguard was once in the advisor custody business, and they got out because this is before you and I were even in this industry. They got out of it really because it was impossible to service, because wealth managers who are working on behalf of clients can't have a problem with customer service. It's like part of what you're selling as an independent advisor is customer service, and you're relying on your back office. And if your back office is a company that is scrimping and saving on customer service, you're going to end up apologizing to your clients all the time. And rather than really try to fix it, they just decided to get out, and they never got back in. You would think, like, of all the incredible initiatives that Vanguard has pursued over the last 10 years, and we've witnessed this company just do amazing things, they never even attempted to do that because of how expensive it is. And it's not the Vanguard way to spend like that.
Yeah.
They focus elsewhere. They focus on being low cost, and they focus on being easy to use. And there's a lot of stuff that they do really well, but it's very expensive to do customer service. And I'm sure that's like job number one of the new CEO, but they're going to have to save the money from somewhere else, or they're going to have to charge more, or some combination. Like it's
the bogleheads are
it's not
the
magic.
forum. The forum is going to go nuts. They're not going to be happy. But yeah, some tough choices are going to have to be made.
Tough choices. All right, you're up.
Okay, I'm going to make
case.
I'm going to make the case for a company that I bought a startup position in today.
Ooh.
That's right, Josh.
Hot off the presses.
The company is called Sherwin-Williams. They're number one and number two. I don't know. I'm sure there's number two. They do paint.
Benjamin
Residential.
Moore and Sherwin-Williams, and that's it. I won't
Cars.
eat any other kind of paint.
Same. All right. They said that we are increasing our full year earnings guidance given our better than expected results in the second quarter. The midpoint of our previous guidance now becomes the low end of our revised guidance. And it's funny, like the numbers weren't that great, but it's guidance, like everything. So the stock was up 7% today. And this is more technical than anything, but it also falls into my thesis of we're going to see a big bull market in housing and housing activity when rates come down. So chart on, please, John. This is the daily. Not afraid to buy a big, fat, juicy candle. Next chart is the weekly, and I'm not a believer in triple top, so hopefully I didn't buy the top. Maybe I did. We'll find out.
This.
What's that?
I love this. Pause on this. I love this setup, Michael.
Thank you.
Look at how effortlessly this stock vaulted off that rising 50-day.
I'm looking, and I'm liking.
And now nobody is down in this stock. If you bought the stock in the last 3 years, you're at worst even, and everyone's up. So now it's mentally, psychologically for people, now it's in their winners camp, which makes them more hesitant to want to sell.
Winners win, Josh. I always say that. And lastly, the company is management is very shareholder friendly. They buy back tons of stock. And so, yeah, that's my case. I bought Sherwin-Williams.
I love that. I don't love that the chat is referring to me as Fred Durst because I turned my hat around. I'm going to do a mystery chart for you, and I think you're going to get this one.
I think so, too.
Okay. So I left the price on, and I'm going to tell you that this company reported earnings today. And I consider this to be the world's most disappointing stock. What do you think it is?
The world's most disappointing stock.
Just a perennial piece of shit. You can't make money in this thing no matter what's happening.
Oh,
what do you think
man.
it is?
Oh,
it's a blue chip. It's a blue chip. It's a company's been in business for 100 years.
What do they do?
They reported today. What are you doing? Podcasts all day?
When did they report? This morning?
Today. This morning.
When?
That's the hint.
Okay.
Pre-open, so it's not tech. No one in the chat has this either. Don't feel bad.
What sector?
You guys are embarrassing me. Somebody got it.
What sector?
I think it's considered consumer-ish or industrial. It's industrial or I don't know. I'm sorry, dude. CEO is female.
Jeopardy music? I don't know, man. What is it?
All right, General Motors.
Oh, okay.
I really thought you had this one.
That was bad.
I must tell you, this
That's
thing
on me.
is, if you're a shareholder in this thing, every day is another opportunity to want to fling yourself off a roof.
Wait, didn't you own this last year?
I owned it a couple of years ago. I'm sure I didn't make money with it. So basically, they crushed their earnings, Michael. Crushed. Like you would think this would be the technical setup looked pretty good going into the number. You would have thought that this would go up 10% finally, and yet fell 7%. Let me read this to you. They're raising several key financial targets for 2024 after easily beating Wall Street's earnings expectations for the second quarter. Listen to this. Earnings before interest and taxes of between $13 and $15 billion, or $9.50 and $10.50 per share. Previous guidance was $12.5 to $14.5 billion, or $9 to $10 a share. Any other stock on earth would rally furiously on a guide like that. But they're restructuring their China business. I don't know why they're in China to begin with. And they have losing tons of money on autonomous vehicles. You know, they have the, what's called Cruise, GM Cruise. They're trying to do like the autonomous taxis and stuff. So they're losing money there. They're going to pull back. And then there's this feeling that we might have just seen the best result that they'll print all year, which is why Morgan Stanley said impressive results considering large losses in EVs, Cruise, and China. History suggests the good times won't last. Thanks, Adam Jonas. When were the good times? This stock's been the same price since emerging from bankruptcy 15 years ago. Let me know when the good times are next, because I haven't seen them.
You know what I hope happens? Just shifting gears off of General Motors and onto Chipotle. Chipotle reports tomorrow. Stock looks really shitty going to earnings. I hope it gaps down 15%. I'm going to buy it.
You going to buy some CMJ?
If it bombs, yeah.
Well, they're going to need to figure out a way to charge $19 for a burrito, because I don't think they could open up that many more stores. All right. Hey, everybody. Did you know tomorrow is Wednesday, which means an all-new edition of my favorite podcast, Animal Spirits, with Michael and Ben Carlson. I don't know if you heard the episode from Monday with Matt Middleton from Future Proof. I loved it. And shockingly, my name didn't even come up once, which is crazy. You guys talked about you.
It's not
you guys
about
talked
you.
about Future Proof for 40 minutes, not one Josh Brown.
It's not about you.
Incredible. Anyway, great episode. I love listening to it. Can't wait for the show tomorrow. On Thursday, Ben is back with an all-new Ask the Compound. We're doing the Compound and Friends Friday with another very special guest. And Jill on Money comes back on Saturday. Thank you guys so much for keeping it locked, watching the show, listening to the show. We appreciate you. Have a great night.